What if I told you some of the best stock market returns come directly after the sharpest declines? It's true, and even though the data is out there for everyone to see, people still get emotional and they still panic and want to sell when they see the market drop 10 or 20%, thinking it will continue to go down further. The truth is, nobody has a crystal ball that we can use to see into the future, but we do have a rear view mirror that we can look at to see what has historically happened after these sharp market declines. So in this video, we're going to do what a fellow advisor friend of mine has always said, which is bring the data, not the drama. And we're going to look at 3 charts that are going to make you a better long-term investor in volatile markets. Before we pull up the first chart, if we haven't met, my name is Jake Skellhorn. I'm a certified financial planner and the co-founder of Spark Wealth Advisors, where my partner Chris and I help people across the country retire with confidence and clarity. All right, so the first chart here I think is pretty timely given that we're kind of flirting with bear market territory at the moment as far as the S&P 500 is concerned. At the time that I'm filming this, it is April 16th. And as of yesterday, I think the S&P 500 is down about 18% from a recent high. So bear market would be considered about 20%. But the first chart here is titled "Stock Gains Can Add Up After Big Declines." By the way, all these charts are from Dimensional Fund Advisors, which is a mutual fund and ETF company. I use them in a lot of my own client portfolios and my own investments, but this is not an official endorsement. They did not pay me or anything to make this video. So just always wanted to get that out there. But anyway, the first one is showing sort of the average annual returns after a 10% market decline, a 20% market decline, and a 30% market decline. And each bar represents a different time frame. So the small bar here is the 1-year average return after a 10% market decline, for example, 3-year cumulative, in other words, total, and then 5-year cumulative. So, and the index that they're using here is the FAMA French Total US Market Research Index, which is essentially the Russell 3000 index or the total US stock market. But the numbers are obviously pretty compelling. After a 10% market decline, the average 1-year return a year later is 11.8%. After a 20% market decline, 21.2%. After a 30% market decline, over 23%. So the main takeaway from this chart, I would say, is that just because the market has dropped significantly from a recent high, whether it be 10, 20, or 30%, doesn't mean it's going to continue to go down. In fact, the historical data says quite the opposite. You're more likely to experience positive returns after those declines than negative returns on average. A prime example of this was just the other day, if you're watching this in April of 2025, where the S&P 500 had its best day in decades. I think it was up just over 10%, maybe 9.5% in one day. So it just goes to show that you can't time the market, and any money that you have invested in the market should be long-term, and you shouldn't let emotions get in the way in the short term. The next chart here I think is pretty fitting given where we're at in the year so far for 2025, and it's titled "Do Downturns Lead to Down Years?" So basically the overarching theme of this chart is that just because the market is down from the beginning of the year currently doesn't mean it's going to end down by the end of the year. So each line here represents a different year's returns. So the bar, or sort of the solid bars, represent the calendar year returns. So for example, in 2005, from January 1st to December 31st of 2005, the market return was 6%, 16% for 2006, 5% for 2007, et cetera, et cetera. And then the yellow ones are obviously where the return was negative for the year. But the dotted red line here was the biggest intra-year drawdown. In other words, the biggest decline from a peak to trough during that calendar year. So as you can see, the stock market has a drawdown pretty much every year to some extent, sometimes significant, double digits, but it rarely, if ever, means that the year is going to end on a negative note. So one of the most extreme examples that downturns do not lead to down years was 2020 during COVID. So the total return for 2020 was 21%, meaning from January 1st to December 31st, the market was up 21%. But in a matter of weeks during the month of March, the market dropped by 35%. So this is obviously where people were panicking about COVID, not knowing what was going to happen with the world. You know, countries were shutting down. So obviously massive panic in the markets during that few weeks. But what we saw for the rest of the year was an insane rally back, and ultimately the market went from down 35% to ending up 21%. So like I said with the last chart as well, you can't time the market. You never know what's going to happen next. If you think that the market's going to continue going further down and you sell your investments and go to cash, that is considered timing the market. And historically, you're probably going to be wrong. So I think this is a good way to visualize sort of where we're at in the year currently in 2025. The S&P 500 is down about 18 to 20% as of today from its recent high. but that does not necessarily mean that it's going to end the year that way. So if there's one chart that I want you to burn into your memory after this video, it's this one, and it's titled The Bumpy Road to the Market's Long-Term Average. And I think most investors in the stock market know that the average return on an annual basis is about 10% for the S&P 500, but what they don't realize is that the average is far from the norm. So going back to 1926, the market has only returned anywhere near 10% about 6 times out of those 9,800 years or so. So it comes with lots of big up years, some down years, some significant down years. But on average, if you want to achieve that 10% average, you have to take the good with the bad. So a good way to show, that the markets are definitely up more than they are down, but you do have to kind of suffer through some of these bad years in order to get the good years as well. So I think that last chart does a pretty good job of summing up investing in the stock market in general and weathering the good times and the bad. But I will add that all of these statistics and all of this data are based on just the stock market. So if you're approaching retirement or already retired, you generally are going to have a mix of cash and bonds in your portfolio as well. So you don't have to sell investments at a loss and provide a little bit more stability. Just how much you have in cash and bonds will depend on your unique situation, your risk tolerance, and your age, things like that. And if you're quickly approaching retirement or recently retired and considering working with an advisor, look for a link in the description below this video. If you see one, that means I'm currently accepting new clients. That won't be the case forever, so I would love to speak with you. But besides that, thanks for joining, and we will see you in the next video.